Good afternoon, friends. My name is Seshadri. I am a cost accountant and a company secretary. I will be taking up this lesson, corporate financial reporting, the subject corporate financial reporting for you. I want to give a small introduction to the subject and possibly give you an overview of how we will be taking classes for this subject. Corporate financial reporting. The subject talks about reporting in respect of a company. How does a company come out with various financial reports? Now, why does it have to come with the reports? Because it has to disclose the results of its operations. What have I done as a company? Have I made a profit? Have I made a loss? One has to disclose these results. One also has to report what is my financial position, which is whether I have funds with me, whether my balance sheet is strong. We need to know what is the position of the organization. So you do this reporting. And when you do this reporting, there are certain processes that you follow in the generation of your reports. Number one, you record the data through double entry bookkeeping. And you also follow the requirements of the Income Tax Act, the Companies Act, when you make these recordings of your accounting data. From the data, you generate various reports, profit and loss account, balance sheet, and cash flows. And in doing this, you also follow certain accounting standards which have been made mandatory in the preparation of these financial reports. Similarly, when you want to record, say, a merger between two companies, when you want to record a takeover of a company by another company, there are certain processes that one needs to follow in bringing the information of the other company into your books. Our lesson, corporate financial reporting, tells you how to do. So this subject, corporate financial reporting, has got 6 sections. Section A, I will share the screen for you. Section A deals with specific Indian accounting standards in the AS, not all the in the AS, to give an idea of how these standards must be used in the recording of your financial data. Section B talks about valuation of shares, the accounting and reporting of financial instruments, and the requirements with reference to non-banking financial companies in terms of their reporting. So valuation of shares, whether you take goodwill, how much of that goodwill, how do you compute goodwill, all that will be form part of your valuation lesson. And on financial instruments that can be converted into cash, your cash balance, your bank balance, your bills receivable, your sundry debtors, how do you measure them, value them, report them, are all part of your accounting for financial instruments. And in the financial sector, the non-banking financial companies have certain provisions. They have a methodology of recording income and reporting results. We will learn about all that. In section C, we learn about accounting for business combinations. I talked about a merger, a takeover. There can also be a restructuring of a company. What are the rules that we will need to follow in terms of valuing the assets, recording the assets in the relevant companies, reporting them in the year in which transactions take place, in subsequent years? Does it differ for holding subsidiary companies? Are there any special provisions there? All this we will see in section C, accounting for business combination and restructuring. In section D, we talk about consolidated financial statements and separate financial statements as directed by Ind AS. So when there is a holding and a subsidiary company, there is a mandatory provision to reflect not only the standalone accounts of the holding company, but also the consolidated accounts of both the holding and the subsidiary. What are the rules related to that? Is there a line-by-line addition of each item of asset and liability? Do you take over the equity, other equity in your reporting? All this we will study in consolidated financial and separate financial statements in section D. Section E is a very important and an interesting exercise. Although the subject is corporate financial reporting, we also look at non-financial reporting, because today there is a great orientation towards ESG. E stands for environmental protection. S is for what the organization is doing to the society. And G is for governance. Is it running its business not only legally, correctly, but also ethically and in a manner that other stakeholders are happy about it? So business is not all about profits. It is also about whether you are using the resources of the environment. I might use a large amount of water. Say, for example, a beverages company, a Coke or a Pepsi will have a large amount of water used in their manufacturing processes. What do they do to recharge the water, or what should they do? There are industries which pollute, let out a lot of carbon emissions. How do you reduce the emissions? Use renewable energy in lieu of fossil fuels and thereby make the environment better. So there is a whole lot of importance that is coming up to non-financial reporting other than financial reporting. Fundamentally, financial reporting is a mandatory one, because if you don't have money, you cannot run your business. But when you are running your business, am I harming the society? Am I harming the environment? Are my governance processes well? You look at it, you report it. Those will be studied in the recent developments in financial reporting. The last section, section F, relates to government accounting. Government accounting is not the same as the general business accounting. The accrual system is not followed in government. Government has a very different way of recording income and expenditure. In fact, they have a budget and authorization without which not even a rupee can be expended by the government. What is the way they record the expenditure? When they collect money from us in the form of taxes, in the form of, say, GST, etc., how do they record this accounting and then take it all the way to the central government for consolidation? Do they have separate standards which they follow in their accounting? How are they looking at moving to an accrual system of accounting? An accrual system of accounting means that I will not only record cash income and cash expenditure, I will also record income which I have earned but I have not received. I will also record expenditure which I am liable to provide for in the said accounting period, but I might not have settled the payment. So, accrual accounting is the government trying to come anywhere near that. All this we will read in section F. So, just to give you the methodology of study in the case of, theoretical portions of this subject, I want to just open up one presentation and show you how we will go about learning on this area. We talked about financial reporting. So what are the recent developments in financial reporting? The first one that we are now looking at is, when we talked about recent trends in financial reporting, the reporting also includes non-financial matters. We call this the 4P bottom line reporting. Earlier it was 3P. They have now made it 4P. It's an extension of triple bottom line. What is a bottom line? In traditional accounting, the term bottom line refers to the operating result of an organization, which is usually recorded at the last line of the income statement. You know that in your profit and loss account earlier, not in the current Companies Act, earlier you always had a net profit, or even in normal partnership accounts, individual accounts, you say net profit transferred to proprietor. That is the last line. That's why it's called the bottom line. So the first bottom line is an economic bottom line. So the quadruple bottom line, quadruple means 4, quad is 4, requires an organization to measure and report on 4 dimensions: the social dimension, environmental dimension, economic dimension, and spiritual dimension of the organization. So they say report on 4 areas. First area we already know. When you report your profit and loss account, your balance sheet, you are there. Bottom line. The second bottom line is how socially responsible the organization has been. What has been the corporate social responsibility initiatives that have been taken by the company, apart from the mandatory 2% spent on the average profits of the last 3 years? Has the company also done something more to the society? Has it done more to its employees in terms of improving their standards of living? And so on. The third bottom line is, have I affected the environment? Am I polluting the environment? If I am polluting the environment, what are the steps I am taking to reduce the pollution? If I am using a lot of resources, I use a lot of energy, I use a lot of paper, what am I doing to conserve the material so that I don't harm the forest? So environment. And the fourth bottom line is about the happiness in people dealing with you, your suppliers, your customers, your employees in the first instance, and the society and the government. They are all very happy that you are existing. For example, you take the Tata Group. You say they are a very nice, well-oriented group, society-oriented. They do a lot of work in Jamshedpur. So how has the society perceived? Are they happy that you are there and you are producing? So this is 4P bottom line reporting. We will see more of it when you come to the actual classes. Good luck. All the best.